Okay. So good afternoon, everyone. Thank you so much for joining us today for our programming, Adulting 101, How to Do Your Own Taxes. My name is Sky, and I'm a librarian at Brampton Library, and I'm joined by my colleague, Natalie. And this program today is presented on behalf of Brampton Library and RBC. Before we begin, I would like to read the Brampton Library Land Acknowledgement. We would like to acknowledge that Brampton Library is located on the treaty territory of the Mississaugas of the Credit First Nation, and before them, the traditional territory of the Haudenosaunee, Huron, and Wendat. We also acknowledge the many First Nations, Métis, Inuit, and other global Indigenous people that now call Brampton their home. We are honored to live, work, and enjoy this land. I just would like to let you know about some upcoming programs at the library. This Thursday from 7 to 8 p.m., don't miss our at-home trivia. The topic this month is pop culture, so hope to see some of you there. This evening, we are also having our Celebrating Black History Through Language and Culture event with Rescue Youth International and BYSSI. So if you're free this evening and want to just join an event where we get to celebrate and learn some new things, please feel free to join. And of course, we also have our March Adulting 101 session, which is how to start a side hustle with the Brampton Entrepreneur Center. So that should be really interesting and hope to see some of you there as well. Also, just some housekeeping. Please be respectful of everyone and keep yourself muted unless you're asking a question. This session will be live streamed and recorded this afternoon and may be used by Brampton Library in our professional portals. If you have a personal finance question, please feel free to reach out to the RBC meeting place directly to avoid sharing any personal information. Closed captioning is available. To turn it on or off, use the CC button at the bottom left of the screen. If you have any questions throughout the session, kindly type your questions in the chat and we will address them. So now I will hand it over to Wanzi from RBC so we can learn how to do our own taxes.
All right, thank you so much, Sky, for that introduction, a little bit about myself, RBC, and my colleague, Caro. So my name is Wanzi Silva. I'm actually the Assistant Branch Manager at RBC Meeting Place. I would say it's a very unique concept that RBC has to support new immigrants, our community, basically to help with a better settlement, perhaps around, you might have questions around employment. So I would call our space a one-stop shop where you can walk into our space or book a virtual appointment, just like how we are hosting events. You can connect with us virtually as well to have a one-on-one conversation to learn about banking in Canada or about banking, how it differs from back home, or if you want to get hired at RBC, how does the hiring process look like? Or about our journeys as new immigrant, we have so many new immigrant success stories that we can share.
Oh, Wanzi, you got muted.
Wanzi, you were not muted.
Okay, I'm back. Can you hear me?
Yes.
Okay, awesome. So I was saying that my team, together with Garcia and Jaspreet, we are here to support you as well. So we will share our email IDs and you can definitely reach out to us on email. A little bit about my colleague, Carol. So Carol is our investment and retirement planner, and she's been with RBC for over 30 years. She's been helping clients with their financial planning journey, I would say, since 1997. And something special about Carol is that she's a very humble and loving individual, I would say, very caring in terms of her, not only to her colleagues, but also to her clients. For her colleague care and for her client care, she's very popular amongst her team here in Brampton as well. And we're very happy that she is hosting our session today on how to file taxes, a high level overview on the tax checklist, But more than that, if you ever have questions about your own financial planning, you can always reach out to Carol as well, and I will definitely share her email ID. So with that, I'm going to pass it over to her. Carol, if you want to say a few words until I pull your deck.
Yeah, I just want to say thank you for the opportunity to speak with you all this afternoon. Taxes and coming to Canada and learning so much. I have to say the Newcomer Center is a fabulous place to connect with. They have so many expertise from, mortgages to investments to whatever the need that you have at their fingertips to help you get settled, to learn as you go. And, at RBC, we're here to work together. And that's one thing I can say over my career is that we all help each other. And our goal is just to make sure that our clients are well taken care of. So Wanzi, if you could start the presentation and go ahead. I think the notes are showing, so maybe you can share without the notes there. Thank you.
All right, give me another quick second here. Why don't I do this? Let me share my entire screen, go back here, and all right.
There we go.
Is that better?
Perfect. Thank you. Okay. Excellent. Thank you so much. So good afternoon, everybody. And again, my name is Carol D'Souza, and we're going to today talk about taxes. And I know that it's not a glamorous topic and it's really overwhelming, but as a new Canadian, this may be your first time submitting your taxes. We're going to share some tips ahead that will help you save you some money and show you where you can go to turn for help. First, we'll talk about the Canadian tax system and who needs to file a tax return, and then we'll jump into potential deductions that you can have. Afterwards, we'll talk about filing your taxes and some offers and apps that can help you out. Before we start anything, I want to say we're not tax professionals. This is general information session that we're going to share, and we're going to share some tips and tricks to help you file. The Revenue Canada, Canada Revenue Agency's website is a great place to start and contains all the information that we're going to talk about today. But filing your first tax return is a complicated process, and you'll likely need some help from a tax professional until you learn how to do it. We're going to discuss a bunch of great tips. Some of them may not apply to everyone here today. If you have any questions regarding your particular circumstances, please consult a tax professional. And Wanzi, you can go to the next slide for me. As mentioned, we're going to start with a quick overview of Canada's tax system, as every country is different. Our tax system is based on a self-assessment principle, which means that you have to complete a tax return each year to report your income and calculate whether you owe tax or whether you're going to receive a refund. Many of the benefits Canadians enjoy are made possible through taxes such as paying for roads, paying for schools for your kids to go to, for our great healthcare system that we have, for Social Security and a retirement, and for public safety, to name just a few. The Revenue Canada agency administers the tax laws for the Government of Canada and for most of the provinces and territories. It's responsible for not only collecting taxes, but other amounts as well. So it collects federal, provincial, and territorial tax. It collects the goods and services tax. It collects for the Canada Pension Plan, and it collects for employment insurance benefits. CRA also delivers various benefits and credit programs to Canadians through the tax system, which I'll review with you throughout the presentation. Next slide, Wanzi. Okay, so today let's talk right now about filing the tax return. Even if you lived in Canada for only part of the year, you may have to file a tax return. For example, you have to file a tax return if you have to pay tax, if you want to claim a refund, or if you want to get certain benefits and credit payments if the CRA sends you, or if the CRA sends you a request to file the return. Canada taxes individuals on the basis of their residency. So residents of Canada must pay tax on their worldwide income, which includes income from sources outside of Canada. Therefore, it's important to determine the date at which you became a resident of Canada for income tax purposes. If you become a resident when you establish residential ties in Canada. So usually that means the date that you arrive in Canada You may come as a protected person, including refugees, within the meaning of the Immigration and Refugee Protection Act. It could be people who have applied for or receiving permanent residency status from Immigration or Refugee and Citizen Canada. It may be people that have received or approval in principle from Immigration. If you're a resident of Canada in an earlier year and you are now a non-resident, you'll be considered a resident for Canada for income tax purposes when you move back to Canada and reestablish your residential ties, because we do have people that are resident, move away, and then they come back again to Canada. Okay, the next slide, Wanzi. So you can take advantage of several tax credits and deductions available to you as a new Canadian. We're going to review some tips that are useful, quick reference for the most common federal tax credits, deductions, and tax assistive programs available to you. Please note, though, that not everyone's tax situation is the same. It's going to be different. Some people will have certain credits and deductions that you'll be able to claim that maybe other people won't be able to, but it just depends on your individual tax situation. For example, if you have children, the child care expenses, you may be eligible to claim those on your tax return. If you've incurred medical expenses for yourself, your spouse, or your children, you may be able to claim those as well. Okay, Wanzi, to the next slide. So generally speaking, you'll have to provide basic personal information such as your full legal name, your address, and all the income that you would have received in 2021 when you file your taxes this year. Make sure you have applied for and received your social insurance number, which is used to identify you for income tax purposes and benefits. A lot of income you earn in Canada will be reported to you in T-slips. These T-slips are mailed to you or available for downloading, usually the first 3 months of the year. T-slips make it easy to report the relevant information on your return because it tells you what box that you need to put it in on your tax return, so it's very easy to follow. If you're already employed in Canada, you'll receive those T-slips from your employer. Your T4 slip will report the income you earned, as well as the tax and other amounts that were withheld and remitted on your behalf by your employer. All of these amounts need to be reported on the tax return. If you have bank accounts and other investments in Canada, you'll receive various other T-slips that report the interest, dividends, and potential capital gains that you may have. A T5 slip is what you'll get for investment income. A T3 slip is for trust income. A T5013, for example, is for partnership income. And a T5008 is for dispositions. That's generally when you sell an investment, a mutual fund or a stock, for example. The information contained on these slips will all be needed to be reported on your tax return. If you start a business in Canada, then you'll need to provide business information, including how much income you earned and what your expenses that you paid. If you've had income from outside of Canada, whether it's employment income, income from real estate, or other investments, since the day you arrived in Canada, you need to report those numbers as well. If you have foreign assets over $100,000, you'll need to report them on what's called a T1135 on your tax return. If you have dependents, such as a spouse, children, or elderly parents, and they're financially dependent on you, you'll have to provide all of their information and details as well. It's important always to keep your address updated with CRA. And if you're eligible for tax refund, you can sign up for direct deposit. So that means the refund will go right into your bank account. Otherwise, a check is mailed to you. Okay, next slide, Wanzi. Okay, so let's focus now really on your income. For the part of the tax year that you were not a resident of Canada, you have to report the following amounts. So income from employment in Canada or from a business carried on in Canada, taxable capital gains from disposing of taxable Canadian property, and taxable part of scholarships, bursaries, any fellowships and research grants that you received from any Canadian sources. For the part of the tax year that you were a resident of Canada, you have to report your worldwide income. So worldwide income is income from all sources, both inside and outside of Canada. However, part or all of that income may be exempt from Canadian tax if Canada has a tax treaty with the country in which you earned that income. And there is a provision in the treaty that prevents Canada from taxing the type of income you received. So for example, in some cases, pension income from outside of Canada may be exempt from tax in Canada due to that tax treaty, a tax treaty that may be with that country, but you must still report the income on the tax return. If you are a protected person, including a refugee, and you receive funds from a charitable organization, such as a church group, or from an individual, you generally don't have to report the amount on your tax return. However, if the charitable organization hired you as an employee, the employment income is received is taxable. Onesie to the next page. So for self-employment income, it's income that's earned by individuals who work for themselves. All income earned this way is taxable and should be reported to the CRA. There are different deductions that may be available to individuals who earn self-employed income. It's best to consult a tax professional to review those for you. For pension income, if you and your spouse or common law partner were residents of Canada on December 31st, 2021, you can elect to split your pension income that qualifies for the pension income amount. This allows the spouse with a higher income earning to pay less tax. To make this election, though, you and your spouse or common law partner must complete and attach what's called the Form T1032 to your tax returns. Okay, Onesie to the next page. Now let's shift and talk about some of the most common deductions or credits you can apply for. So goods and services tax, which is the HST, which we all know about, the GST and HST, the harmonized tax, is a tax-free quarterly payment that aims to help you offset all or part of the GST or HST that you pay throughout the year. However, it isn't available to everyone. So to qualify, you have to be at least 19 years of age, or previously had a spouse to be a parent who lives with your child, or previously were a parent who lives with a child. You have low or moderate income. You are a resident of Canada. So the CRA will determine if you're eligible for the GST and HST credit when you file your tax return. So make sure you file a tax return if you're eligible for the credit, even if you've not received income for the year. So that's important because you could have children that are maybe age 19 or older and aren't working, but as long as they have a SIN number and they file that tax return, then they're now eligible for that credit. The Canada Child Tax Benefit, so it's a tax-free monthly payment made to eligible families to help them with the cost of raising children under the age of 18. The CRA uses information on your tax return, so that's why it's important to file, and benefit return to calculate how much of that payment that you're eligible for. To get the CCB, which is the Canada Child Benefit, you have to file your tax return every year, even if you do not have income in the year. If you have a spouse or common law partner, they have to file a tax return every year as well. Benefits are paid over a 12-month period from July of one year to the end of June of the next year. And your benefit payments will be calculated every July based on the information that you and your spouse, if applicable, your income tax and benefit returns from the previous year. So that's why it's important that you both file those tax returns. Generally, you can't deduct moving expenses, for example, incurred to move to Canada. However, if you've entered Canada to attend courses as a student, and you attend full-time, the enrollment program of post-secondary level or university, college, or other educational institution, and you receive a taxable Canadian scholarship, bursary, or fellowship, or research grant to attend that institution, you may be eligible to deduct moving expenses from that income. However, you can't deduct moving expenses if your only income is that scholarship or that fellowship or bursary. You have to have other income as well to be able to offset that. Okay, the next slide, Onesie. If you have an RRSP, which is a registered retirement savings plan, you cannot deduct contributions you made to an RRSP in 2021 if this is the first year that you've been filing a tax return in Canada. It's always 1 year behind. So if you work in 2021, you file a tax return, the first time you can make a contribution to the RSP that's deductible would be 2022. However, if you filed a tax return in Canada for any year from 1990 to 2020, you may be able to deduct a claim for RSP deductions you made in 2021. The maximum amount you can deduct is based on certain types of income you earned in the years, and that's why it's important to file your tax return, because when you do, you receive what's called a notice of assessment. It comes back in the mail to you after you file or electronically, and it'll tell you what the RSP deduction room is going to be for the next year. If you make spousal or child support payments, you may be able to deduct the amounts you paid even if that former spouse or common law partner does not live in Canada. Lastly, each province or territory has their own set of taxes and credits that you may be able to apply for. In the year you immigrated, you usually have to pay tax to the province or territory where you lived on December 31st of the previous year. Similar to the federal tax credits, as an immigrant, you may be limited in the amount that you can claim this year for certain provincial or territory credits. Next slide, Wanzi. So filing your taxes might seem daunting. It is for some of us who've lived here our whole lives, but now you're armed with some tips and tricks. It's relatively easy, and you can always reach out to a tax professional for assistance. Even if you aren't required to file a tax return, it may be in your advantage to file one anyway, so that you're eligible for that HST and GST credit that I talked about, as well as a child tax benefit, because it'll provide you, lots of income there that maybe you wouldn't have been receiving otherwise. And it also sets up your information on a file with CRA for future filings. The deadline for filing your personal tax return is April 30th, and that's for your T1. If you're self-employed, the tax return deadline is June 15th. If April 30th or June 15th fall on a Saturday or a Sunday, then it's due the next business day, the next Monday. If you do not file your tax return by the deadline and you owe tax, you will be charged interest on the unpaid taxes plus a late filing penalty. Interest is compounded daily and quickly, and it really adds up. So it's never too late to file. If you haven't been filing, I would suggest you speak to an accountant right away to get that rectified. The sooner you reach out and get it rectified, the sooner that interest is not being calculated and the penalties aren't being charged. Next slide, Wanzi. So now what? Okay, it's time to take these tips and file your tax return. Be sure to take advantage of the offers available to you. So the RBC mobile app, if you're an RBC client, helps you, shows you ways that you can pay your taxes through online banking and through the mobile app. So it makes it really easy. Despite living in a digital world, we don't even have cash here all the time, right? So you're going to have to, some papers, the work that you're going to have to keep track of. It's really important that you keep track of all that information. So if you're self-employed, then you need every single receipt that you have for filing. If you're doing your personal tax returns, you need to keep all the slips that come in place. Make sure that you keep them in a safe place so you don't use them. And make sure that you check out the resources on the CRA website, particularly the document called a T4055, which is for newcomers to Canada. And that's a really important document to help you understand what you need to do and what the filing deadlines and all that are. Okay. And that's it for our presentation. I know it seems like it was kind of quick and it was a lot of information for you, but let's see if we can open it up and see if anyone has any questions. Remember, this CRA site has a lot of tax resources available to you, so it's really important that you check those out. It's really important that if you're filing your tax return for the first time that you get some help from a professional, because it can be quite complicated and daunting. And I would say if your tax return is pretty simple, once you get the first one under your belt, there are a lot of tax programs that you can use that you'll be able to do it yourself going forward, but just getting that first one under your belt so you know where everything goes on the tax return really does help you for when you have to do it again. But the self tax returns, the programs that you can get are very easy as well, and they certainly help you and walk you through the process. So let's go out and see if anyone has any questions.
So there was one question in the chat.
Mm-hmm.
So it's from Wahid. Question, my children live with their mother in Etobicoke, but I pay for specific things for them. What can I claim?
So it depends on what you're paying for. I mean, if it's health, costs for health related medical expenses, and that's something that you can claim. It depends on what the situation is with your spouse, whether you split custody of them, it's a 50-50 arrangement, whether you pay child support, all of those things will be part of the answer to that question.
Okay, thank you.
You're welcome.
So I just wanted to add something, until our folks are ready to ask the questions. And again, it's a good time to ask questions from the expert. We have almost about another 20 minutes or so. So even if it's just about, investment types, for example, what's a tax-free, an RRSP, all this can be linked in terms of filing your taxes, not only the process of filing taxes, but understanding which financial instrument should be best utilized, even to get tax credit, right, to get those benefits. So feel free to ask those questions as well. And I want to let you know that if you're filing taxes for the first time, you can also use certain apps or websites like TurboTax. Do your research before really filing your taxes, because certain apps give you like a free one-time access to file your taxes. I know when I was a new immigrant a couple of years ago, I filed my first taxes through TurboTax, right? So look at those highly recommended free apps as newcomers, instead of having to pay those fees. Just explore and see, and it should be an easy process because you don't have probably not much income for the first year. So less complications as well. So explore TurboTax feature as well.
That's a really good point, Wanzi. And I will touch a little bit about difference between an RRSP and a TFSA, because we get asked that question all the time. So an RRSP is something that reduces the income. So think of it this way: you get a T4 slip from your employer, your income is $25,000, for example, and you put $5,000 into an RRSP. What that does is then it lowers your income now from $25,000 to $20,000. So your tax bracket is lowered. You've now paid tax on that additional $5,000 that you've now put into the RRSP. So basically, you get that tax back. Right, so you prepaid when your employer did your taxes, you're going to get that back. So it's a great way to put money away for retirement. The money in the RRSP grows tax-free, and then when you take it out, the idea is when you're in retirement time frame, you're taking it out and you're in a lower tax bracket than in the years that you're working. Now you can use that money towards a home down payment for your first home purchase. You can take up to $35,000 out of the RRSP. That's tax-free. That comes out to you for that first home, and then you get to pay it back over 15 years. It's a great tool and a great resource available to you. Now, a TFSA works just like the RRSP in that you get to invest it in investments inside the plan. The difference is when you put money into a TFSA, you don't get the tax break up front that you do like an RRSP. But again, you get to invest it the same way as an RRSP does. It grows tax-free, just like an RRSP does. The big difference is that, remember, the RRSP, you'll get that deduction up front when you put it in. The TFSA, there's no deduction up front, but when you take it out, years later, for whatever the reason is, all the money that you take out is tax-free. So there's always a balancing act with the clients that we give advice as to whether I should put money in an RSP or should I put money in a TFSA. It depends on how much income you're earning. It depends on what you're going to need the money for. And it also depends on everyone's individual circumstances, age as well, right? So if we have a client that comes in and they're 65 and they're going to retire in a couple of years and they've got quite a bit of savings and pension and RSPs, then we might recommend the TFSA as an option, right? So there's lots of different options available, but those are the two, the primary difference between the two. But a lot of people don't understand, and they think a tax-free savings account is like a bank account, and they put money in and they take money out. So there's an amount that you're allowed to put into the TFSA based on the time that you became a resident of Canada. And it's really important that you stay within those limits. So it's very important that when you're putting money into the TFSA and you need to take money out of it, that you understand when you can re-put more money back into the plan. And so your financial institution or your advisor will be able to sit down with you and explain that. It's really important that you understand that. And it's really important that you understand that a TFSA has investment options. There's savings, GICs, and mutual funds or stocks all under that investment that you can do for a TFSA. And that's important because you want that money to grow as much as you can. Okay.
Great point there, Carol. So there is one more question. My spouse has been unable to get his T4 from a new employer. Do you know if Service Canada can do anything in this instance?
So the new employer has until February 28th to submit that T4 slip to you. If for some reason you're unable to get it, you can go, it is reported to CRA. So you can, if you have your CRA account, you can log in and you will be able to see all that information there as well, because everything that's remitted to CRA, they have it on file. But the employer does have until February 28th to get that slip to you.
Yeah, sounds fantastic. I just also wanted to add, especially because we have, I'm assuming we have newcomers probably listening in and joining us as well, especially for RSPs. I think unlike the TFSA where you have a room, unlike, you know, there are conditions that, okay, you have to be employed, for example, to open an RSP, always refer to an expert, like reach out to your banker, reach out to your investment advisor, is because we have so many newcomers, you know, who walk through to our space and say, hey, Wanzi, you know what, I just started working a couple of months back and it's RSP season. Everybody talks about retirement planning. And you know what, I ended up opening an account, an RSP account, not even knowing the limit, right? Not even filing their first taxes. And guess what? They get a penalty of literally 1% per month for those additional amounts or the amounts that they have exceeded. So remember, especially when you're making a contribution to an RSP, please you know, reach out to your bank, go look up on your CRA and see what's your available room for that contribution, right? It's really very important. You don't want to over contribute and you know, have to pay penalty.
Absolutely. So think of it this way, when you file your taxes and you get that nice piece of paper back called the Notice of Assessment from Revenue Canada, that on that slip of paper, it tells you how much RSP contribution room you have for the next year. So you have to have a year of earned income and of tax filing in order to accumulate room. So if 2021 was your first year working, you'll file your tax return for 2021, you'll get the Notice of Assessment back and it's going to say, okay, Wanzi, you have $2,300 in room that you can contribute to an RSP for 2022. And then the next year you'll file again and it's going to tell you, okay, Wanzi, you didn't put that $2,300 in. Now you have $5,700 in RSP room. It continues to grow for you if you don't use it. So that's important to remember to look at that paper because that is a guideline for us. And if you're going into the bank or to your financial advisor to do your contribution, it's really important too, you bring that Notice of Assessment with you, because we have had people who You know, they've been living in Canada for 5 years. They maybe put a little money into the RSP and they forgot to deduct it. So we sometimes find little snippets of great data on there that help you for amounts you put in RSP and never claimed. So it's really important to bring that notice of assessment as well for us to review.
Awesome. I just also wanted to ask, one question, or maybe if you can elaborate a little, Carol, is about lifelong benefit in terms of the RSP. I know people think that retirement planning, opening an RSP, the benefits to enjoy, tax-free withdrawals is perhaps only the first-time home buying.
Yeah.
But there is a one-time withdrawal that you can withdraw, right, for education purposes. Why don't we explain a little bit on that as well?
Yeah, so if you're deciding that you want to go back to school and you don't have, you need to be able to support yourself to go back to school, there are ways under the lifelong learning program that you can take money out of the RSP, just like you do under the home buyers plan, and you can use that money for a qualified education program. So it's a great way to be able to utilize the RSP money as well. You do have to pay it back like you do with the home buyers plan, but it's a great benefit there for you.
Awesome. I think we have one question, but yeah, go for it. Yeah.
Go ahead. Yeah, so it says, are there new credits with regards to the pandemic? So there are some. I'm not 100%, to be honest with you, up on those credits. I would speak to your tax professional. But I do understand there are some credits of if you go on vacation in Canada and you spend money, that you can be able to deduct some of that to show that you supported Canada and our different provinces and companies that offer travel available. So I would suggest that you just double check into that, because I'm not 100%. I do know they're there, but I'm not 100%. I haven't read up on them to see exactly how they work and how much you can claim. But I'm assuming it's a percentage of how much you spent on any travel that you did in Canada. Hopefully that answers that question.
Great. So let's wait for a few more minutes, if our participants have any other questions. But let me ask questions on behalf of our participants as well, for the benefit of everybody. Let us know a little bit about RRSP loans. A lot of clients, because it's tax season and we are getting close to deadline as well. People ask us, what's the benefit of taking a loan and contributing towards your RRSP? And perhaps if you go on your own, offers and opportunities, if you check your online banking, all of these pop-ups might be already there, but you don't know how to action or what the benefits as well. So why don't you talk about why it's important to kind of explore those features, benefits in terms of returns, right? Not only the employment deductions that you talked about, but in terms of credits as well.
So for an RRSP loan, it's basically money that you borrow from your financial institution. So I'll talk about RBC because that's the one I'm familiar with. But generally what happens is it's a loan that you can take generally anywhere from $1,000 up to usually $20,000. Sometimes it's more. Basically, the loan is paid back over a 12-month period. And that's when the interest rate's at prime. So prime lending rate is the cheapest way that you can borrow. If the loan is paid over a 24-month period, then it's prime plus 1.5. Now, not everybody does a loan make sense for, but some people it does. And lots of people will take the loan and they do what's called a deferred payment. So they don't have to make a payment for the first 90 days. Yet Wanzi's posted the rate's 2.45 as of today, which is great rate. But you can do a deferred loan, meaning you don't make a payment. Some people do that because they know when they file their tax return, they're going to get enough of a refund that they're going to be able to pay that loan off, and they don't want to have to make a monthly payment. Interest is still accumulating, but they don't have to make a payment for those 90 days. Lots of people will do it, just because they're self-employed and they've got, a larger amount of income than normally that they would receive in a year, and they want to take advantage of that higher amount that they can use as a deduction. So it's a great way to be able to, pay back if you can't afford to do so. Think of it, if you borrow 5,000 divided by 12, that's how much your payments are going to be, plus a little bit extra for interest. But a lot of people take advantage. It's really quite popular. Now people have lines of credit, and maybe if they own a home, they may have like a home line plan. So sometimes people will use an existing line of credit facility that they may have to do it, but the RRSP loan is great because it's always at prime. You don't have to worry about it. And it is payable back anytime without penalty. So it's a great way to get that RRSP started and get that deduction that you may need. It's a great tool.
Yeah, thanks for that, Carol. And I think, certain clients, if, for example, if perhaps your spouse is in a higher income bracket,
yeah, so,
and he's already, right, he has probably utilized the RRSP room. But if you're in a low income bracket, again, you can still borrow through RRSP loans and, make contributions as well through our RRSP contributions, right? Carol, if you can explain a little bit on that.
Yeah, so what happens a lot of times is, say, for example, Wanzi and I are married. We're a partnership. Okay, so Wanzi makes more money than I do, and you want to be able to put money into a spousal RRSP. So what it means is that she's making more money. She makes the contribution, but it goes into my RRSP, for example, and she gets to claim that deduction on her tax return. So it lowers her taxable income because she's making more. It goes into my RRSP. It grows in my RRSP over time. And then when I'm going to take the money out, I'm taxed on it. Wanzi's not taxed on it. There are rules that you can't do a redemption out of the RRSP within 2 calendar years, because then it gets taxed back to the person who is the contributor. But it's a great way to income split for those people who maybe don't have a pension. You may have one spouse that has a great pension through work, and their spouse doesn't have a pension. So it's a way to be able to save money under that other person and have more of a split income in retirement. Right now, Revenue Canada allows us to do splitting of income in retirement, but we never know when that could change. So that's why, for a long time, the spousal RRSP was a great option and people used it and utilized it. And then the government came out with the option to split income in retirement, and it kind of went to the wayside. It's kind of come back more because we never know when that could be taken away, that income splitting option. So that spousal RRSP has become more popular in the last few years, I would say, again. And it's a really great way to income split and make sure that your income is more balanced, right? Your assets are more balanced, your savings are more balanced, and then you've got that difference in income, whether someone needs to take it. Some people do it, and then if they're going on maternity leave, for example, then a spouse would have put money into a spousal RRSP when you're planning for a family, for example, and then when you go off on mat leave, if it's been 2 years, then that spouse with the income that's staying home with the children or the child at that time can take the money out in a much lower tax bracket and help cover the expenses that the family's going to have. So there's lots of different utilizations for the RRSP, and that's another good example of the spousal and why it can be important and why it can be very effective in managing your expenses through that time when you're off. Because we all know raising children is not cheap; it's very expensive, and getting your your maternity benefits sometimes aren't enough, right? You don't have enough of a top up and you need more. So that's a great way to help sustain that cash flow.
Awesome, Carol. Thanks for that. And I do want to add as well, I know a lot of newcomer clients that I see, they're well established. Sometimes they bring a down payment from back home to buy their first home. And say, down the line, now you're ready to buy that first home. Let's say you have a contribution room, and you're hoping to buy that home within the next couple of months. A little bit of a word of caution here is, if you want to utilize that first-time home buyer withdrawal through your RRSP, make sure you leave those funds, at least 90 days in that account, right? So example is in January. Let's say now it's the tax season. You already know from your notice of assessment what your tax room is. you make that lump sum contribution, but you're also in the process of buying your first home. So you want to make that withdrawal, that first time home buyer withdrawal. Make sure those funds are at least in the RSP for 90 days before that withdrawal is being, taken. Plus, do not, we wouldn't really recommend blocking those funds in a GIC or in mutual funds if you know that it's a short-term goal that you have. Okay. So, because we don't want you to run into, again, any additional taxes or any penalties.
Yeah, I was just going to say that. Yeah, you want to do like a short-term GIC, maybe 30, 60, maximum 90 days, so that the money is available to you to do that withdrawal, and it's available for that down payment. It's really important. And one thing about repaying it, I'll just tell you, because not everybody knows. So as I said to you, you have to repay it over 15 years. So a lot of people think, oh, how am I going to be able to manage to make that payment back to my RSP plus make regular contributions, because the amount you put back under the home buyers isn't a contribution for RSP purposes. It's just putting the money back. So some people say, well, what happens if a year that I can't pay it back? Something happens, I lose my job or something happens. The worst case scenario is that 1/15 of the value is what you have to pay back every year. If there's a year you can't pay it back, the worst case is that 1/15 amount is added to your income for that year. So it's not the end of the world if 1/15 of that amount you took out is added back to your income. It's not the worst thing in the world, so don't panic if that situation does happen. It just gives you lots of flexibility there. And it doesn't have to be paid back to the same plan you took it out of. So say, for example, you take 35,000 in an RSP. If you're lucky enough to be able to have that and take it out from your RSP at Scotiabank, for example, and then when you want to start repaying it again, you no longer have a relationship there and you want to pay it back to another institution, you can certainly pay it back to, doesn't matter, as long as it goes to an RSP, whether it's a plan through your employer or whether it's a plan through a financial institution, you can use that as your contribution and payback. And that's another thing maybe I'll touch on just quickly, because I know it's RSP season, is that if you have an employer plan, if the employer offers you a group RSP or a group savings plan, take advantage of it. Because generally what it means is if you put a certain percentage in, they're going to match a certain percentage. So sometimes the employer may say, if you put in 6% of your pay, we'll match 3% of your pay. If you're lucky, your employer is matched dollar for dollar. So it's a great way to get free money from your employer, because if you don't take advantage of it, they're not going to give it to you in another way. So, save for your retirement and allow them to give you that free money towards your retirement as well. So it's a great program. And if your employer doesn't have that program and there's enough of your employees, I mean, even if you have 5 employees at a company, you can ask your employer, what about doing a group RSP plan? It's a great way to kind of get you to save and get yourself set up for retirement, right? Because the money comes right off your pay and you get that tax refund automatically from your pay. It's not like when you make an RSP contribution somewhere else, you have to wait to file your taxes to get that tax back. When it's through your employer and through your pay, you get the immediate tax back right away.
Okay, so maybe I'll ask one final question before I pass it to Sky. Cool. So, you talk about retirement plans at work, right? And then we hear about CCTs, OAS payments. Why is it important to have a separate RSP, right? And we're talking about tax planning. People in Canada invest in RSPs a lot. Why is it so important? Isn't the CPP or OAS benefits or the company pension or whatever, isn't it enough when a person retires in Canada? Given your experience of like 30 plus years, especially with RBC and helping so many clients with their goals, you've seen the real stories. You've gone through it yourself. You've helped people. Why is it important to start early?
It's really important to start early, especially, you know, when you're young. You don't think that that $25 or $50 a month is going to add up, but over time, the compounding when you invest it, I mean, don't leave it in savings, invest it, get it investing. The best gift that you can give to any child you have is to start them saving earlier. The best gift you can give to yourself is to start saving early. When you retire, you get Canada Pension Plan, and it's only for the number of years that you've contributed into it. So Canada Pension Plan is what you contributed, you get back. Old age security is based on funding that the government has, and taxes go towards that. So old age security is based on an amount that's given if your income is lower, right? So you get that old age security amount as well. But the two combined, even if you've worked in Canada since you were the age of 18, and the most you're going to get is, you know, maybe 14,000 from Canada Pension if you're up in the upper amounts, have always made a decent amount of money and getting, you know, the higher amounts. And your old age security is like $500, say. So think of it that way. If you're getting $6,000 a year from old age security, and maybe you're getting 12,000 from CPP, if you're lucky, are you going to be able to live on that? No, you're not going to be able to live on that. So you're going to need other savings that are going to help fund that retirement. So that's why if you're lucky to work for a company that has a pension plan, they're few and far between now. That's why I say take advantage of those programs. If there's a group RSP, take advantage of that program and then save yourself. Whether it's an RSP to get, you know, reduce your taxes to give you a tax break at tax return time, whether it's tax-free savings account or other investment options, every way that you can save is important. You just need to sit down with an advisor and figure out which is the best combination for you to help you and your family. And, you know, don't think that you can't afford it, because just putting aside, like I said, $25, $50, $100 a month, whatever you can afford, what you get used to, the outflow, you don't even miss it going, right? If your pay goes in and that money goes out automatically, think of it like going out to dinner. You know, you go out to dinner as a family, and how expensive is that? So rather than maybe going out for dinner once a week, 4 times a month, maybe go out for dinner 2 or 3 times and put that money aside, right? To grow for you and your family for the future. So it's all about looking at your expenses, looking at your budget, looking at what you can afford, and then saying, do I really, you know, I always say to some clients that are not very good at saving, I always say, when you're going to buy something that isn't your food, that you need to support your family, to feed them, it isn't a bill that you have to pay to cover the shelter of your home, think of it as, do I need it or do I want it? Right? So if you need it, you have to have it to take care of your family, then you have to have it. But if you want it, it's just a want and you don't necessarily need it, consider, do I really need that, or can I walk away from it? Can I manage without it? If it's a matter of putting that money aside to save or not. So it's all about balancing all of those things out and realistically setting a budget. Only you know what your budget is, but sitting down every year, I say January is a perfect time, right? We're into February. You've already got January under your belt. You know what your expenses are, your rent or your mortgage payment, your utility expenses, what your food is. Food is going up. It's dramatically going up. Gas is going up. But sit down and reevaluate what you're really spending and how much is left over at the end of every month. And then say, of that, how much do I really need to save? And RBC has a tool on, everyone who's an RBC client has it. It's called My Advisor. And it's a custom financial picture that you can create. And if you don't have it, we can certainly help set it up. It's a great way to list what your income is, what your expenses are, and what your goals are. Is your goal to save for a home? Is your goal to put a child through school? What is your goal that you want to save for? Is it retirement? What is it for? And then you can set up saving strategies to those goals based on what you have already saved and what you can afford to save. And it's a great way to look at it and say, okay, if I can save $40 more a month, how soon will I get to that goal? Or how much am I shy of that goal? And what can I do? What can I look at as far as my expenses? And how can I make it all work? And it's a great, fabulous tool. It's a free tool. And I encourage every customer to sign up for it and use it. And if you need help with how to figure it out, that's what we're here for. We're here. We got a 1-800 number that can help. We've got branches that can help and get you set up for success.
Sounds great, Carol. And I think we have one more question, one final question, I would say, before we wrap up. So the question is, if I think we touched upon it a little bit, but let's hear it from you, of course. If I already have a group RRSP with my employer and my bank advisor suggests to open another one with the bank, shall I open? Having two RSPs, does it make a difference having two RSPs?
So it depends. So the group RSP, there's a couple of things that I'll say. When you have a group RSP, it's with a company. So our RBC has group RSPs, Sun Life has group RSPs, Manulife, Great West Life, for example. They have programs that your employer can sign up for, and they give you investment options as to how you can invest the money, and you get choices. Some of them have multiple choices, some are limited more in the choices that are available to you to invest in. That's a great way to have all your money in one spot, makes it easier because it's all in one statement. However, when you sometimes need to withdraw money from it, whether it be for a first-time home buyer, maybe it needs an emergency, something happened, your roof happened and you need to repair it, you don't have any money but from your RSP. Sometimes you have to get your employer's permission to take the money out. Second, in that thing is that generally group companies will provide data back to the company that tells them how much they have in total in the plan. So if you don't always want your employer to know all of your savings, then maybe you don't want to have everything all in the group RSP, and having the separate plan helps. So it does help for when you do need to take money out if you don't want to have to get their permission. Not always do you have to, but sometimes you do. If you don't want them to be able to see what you have and you want to have different options that are available. Some people like to be able to manage the money themselves through a self-directed, and your employer may not give you that option. Sometimes the options for investing aren't a huge supply of options. So then you may want to have another plan that offers you more potential for different investment options. It all depends on the person's preference. But it doesn't matter whether you have more than one or two, as long as you stay within that contribution limit. That's important, as Wanzi said, because there's a penalty if you go over. That's why looking at that notice of assessment and bringing it into the bank is a great way, or your investment firm is a great way for them to review it to see, have you over contributed? Is there money you've contributed and you haven't deducted? What is the limit that you have, and how can we help make sure that you don't go over that? Hopefully
Fantastic.
that explains it.
Yeah, thank you so much, Carol. And I think, I think we answered the question as well. So something really important I just wanted to add before we wrap up is, I know we talked about how to file your taxes, the checklist, when the deadlines are, and a lot in detail I think about RSPs, TFSAs. As much as you've invested in these amazing tools, always review your investments at least once a year. Don't think that, I've set up an RSP, I've set up a TFSA, and it's done. I've done my part. Make sure you sit with your advisor, sit with an expert to review those investments to see if it's rebalanced, if it's in the right, tactical investment method. Are there any how the charges looking like, for example, the management expenses. Can you perhaps look at other investment tools to diversify? So it's really very important, even whether it's a group RSP or an individual investment that you have made, to review it annually with an advisor as well. All right, so with that, I'm going to pass it back to Natalie and Sky.
Well, thank you so much, Wanzi and Carol, for such a informative session. Financial literacy is so important, and I'm glad that we were able to bring that to our customers today. So thank you for all the information, and thank you everyone who joined us this afternoon. We hope you learned something new, and remember, you can always reach out to Wanzi and her team, or Carol. Their information was put into the chat. So hope you all have a great evening. And thank you again for coming. I will be ending the live stream and the recording now.